Thanks for joining us for today's webinar on tax questions retirees often get wrong. I'm Ryan Michelson. I'm a certified financial planner and advisor at McCarthy & Cox, and I'm looking forward today to going through this quiz with you. We plan to host one of these educational webinars per month, and our next one will be on April 20th on the ARC investment fund. So watch out for our communications on that coming up soon. They say that the only two things that are certain in life are death and taxes. And until the first one comes, we've all got to deal with the second, whether we like it or not. All right, so the first question, will your tax rate be higher or lower when you retire as compared to when you were working? Will it be higher, will it be lower, or does it depend? We'll give each slide just a few seconds for responses to come in, and then I'll give you the correct answer and a little bit of explanation. All right, we've got some answers rolling in here. So at least one person thinks it'll be lower. And I realize with the first question too, some folks are probably still getting logged in here. So I'm going to go ahead and answer the question though. So the correct answer is it depends. So anytime that we're talking about taxes, people make their retirement plans with the assumption that they'll fall into a lower tax bracket once they retire, but that's often not the case. So just as when you were working, your tax rate and your bracket depend on your total income from all sources and your filing status. And so although those sources of income may be different from when you were working, it may be shifting from W-2 wages over to pension or 401k or IRA income, but it's really the total amount and your filing status that will dictate what bracket you fall into. So don't make the assumption that just because you're retired, your tax bracket will automatically be lower. Next question. I get this one a lot on a personal basis. Are my Social Security benefits taxable? Yes or no? All right. Well, if you're receiving Social Security benefits, you already know the answer to this question. And it is yes, although we technically could probably say it depends as well. We just don't want to make that the answer to every question. So based on what the IRS calls your provisional income, up to 85% of your Social Security benefits are subject to federal income taxes. To determine your provisional income, you take your modified adjusted gross income, you add half your Social Security benefits and add all of your tax exempt interest if you have that. And that's your provisional income. Now, if that formula sounds like government gobbledygook, think of it this way. The more other income you have, the more of your Social Security will be taxable as income. And we have a calculator that can help to estimate what that percentage looks like for you based on your specific income sources and income amounts. And also, one nice thing about Social Security when it comes to taxes is that the state of Ohio does not tax those benefits as income. So that's at least some savings as compared to some other sources of income. All right, third question. I've retired. Can I still contribute to an IRA? Simple yes or no. I'm actually impressed with how many of you answered yes on this one. A lot of people think that answer is no based on just day-to-day experience, but you are correct. You can, under some circumstances, still contribute to an IRA even after you've retired. If you're retired, you have earned income. That's the sticking point. You may be able to contribute to either a traditional or a Roth IRA. To be eligible, you must have earned income below the phase-out rules, so there are certain limits that your income has to fall within. In the past, the cutoff for making these contributions to IRAs was age 70 and a half. Once you got past that age, you could no longer contribute. but that age-based restriction was actually repealed back in 2020. So there's no age cap. As long as you have earned income, you can make a contribution. Now, just on a practical level, many people are actually withdrawing from their IRAs and other retirement accounts by this point. So this doesn't really come up too often, but there are some cases where it may be appropriate to consider making some contributions if you have that earned income. All right. Once I retire, are withdrawals from Roth IRAs tax-free? Yes or no? Now, this is Roth IRAs specifically, not all IRAs. Some say yes, some say no. So the correct answer, with some caveats, is yes. Roth IRAs come with a big long-term tax advantage. Unlike their 401k and traditional IRA cousins, which are funded with pre-tax dollars, you pay the taxes on your contributions to Roths up front. So your withdrawals are tax-free once you retire and meet the other Roth requirements. There are two tests to get your Roth IRA gains out tax-free. And those are once you have held the account for 5 years, that's the first one, and once you are over 59 and a half. All withdrawals are income tax-free. Now, I should note here as well that the principal or the contributions to a Roth could always be withdrawn tax-free at any time because those contributions were already taxed. But the gains specifically is what we're talking about here that have to meet those two tests before they are tax-free. Are post-retirement rollovers from a 401k plan to a traditional IRA tax-free? Yes, no, or only if done properly. Looks like we've got all the possible answers covered. You guys should probably know this by now. Anytime there's one of those hedgy answers in there, that's usually the one to pick. But so the correct answer is the third one, only if done properly. There are two types of rollovers from a 401k. There's a direct rollover and an indirect rollover. In a direct rollover, the funds move directly from one financial institution to another, not payable directly to the individual. In this case, the rollover is not counted as taxable income. With an indirect rollover, the 401k funds are paid to the individual, who then turns around and writes a check to the receiving IRA institution. In this transaction, the 401k is typically required to withhold taxes before sending the check to the individual. So that amount is not available to be redeposited into the IRA and then can create taxable income. For obvious reasons, then the majority of rollovers that we process around here are done as direct rollovers. That usually makes the most sense, but as always, there are caveats to that. I received some money from an annuity that I own. Is it taxable? For sure, no, or probably. Well done, everyone. So the correct answer is, probably. The responses are a little delayed, so sometimes what comes in after I started talking. So the correct answer is probably, or at least some of it will be taxable. If you purchased an annuity that provides income in retirement, a stream of income, for example, the portion of that payment that represents your principal is tax-free. The rest is taxable. The insurance company that sold you the annuity is required to tell you which part is taxable and how much. Different rules apply if you bought the annuity with pre-tax funds, such as from a traditional IRA. In that case, 100% of the payment would be treated as ordinary income. In addition, be aware that you'll have to pay any taxes that you owe on the annuity at your ordinary income tax rate, not at the preferable long-term capital gains rate. The next question, are RMDs calculated the same way for distributions from multiple IRAs and multiple 401k plans? So in other words, if you have several different IRAs or several different 401k plans, can you aggregate those all for taking required minimum distributions? Yes or no? So the correct answer is no. There's one important difference if you have multiple retirement accounts. Now, if you have several traditional IRAs held with different places or even held within the same place, the RMDs are calculated separately for each IRA, but can be withdrawn from any of your IRA accounts. So think of IRAs, traditional IRAs, as being able to be pooled for the purposes of calculating your RMD specifically. On the other hand, if you have multiple 401k or other retirement specific accounts like a 403b or a deferred comp plan or things like that, each one must be calculated separately and withdrawn separately from each account. So there is no pooling or aggregating with those company sponsored retirement plans. Each one has to be withdrawn separately. For this reason, some 401k administrators will calculate your required distribution and send it to you automatically if you haven't withdrawn the money by a certain date. But most IRA administrators do not automatically distribute the money from your IRAs. They don't know what you may have taken from another IRA somewhere else. So most IRA providers will not automatically send you an RMD unless you request them to. If you have multiple types of retirement plans out there, be sure you're taking the required amount from each one. This is a reason why some people consider consolidating some of their retirement accounts if it makes sense to do so. I turned 72 this year. Do I have to take my first required minimum distribution by December 31st? Yes or no? A little bit of a trick question here. So the technical answer is no. Normally, you have to take a required distribution for each year after you turn age 72 by the end of the year, so December 31st. But be careful. You don't have to take your first RMD until April 1st of the year after you turn 72. So if you do that, if you delay the first withdrawal, you'll also have to take your second withdrawal by December 31st of that same year. So if you defer the first one, the next year you'll have to take two required minimum distributions in the same year, which will both show as taxable income that calendar year. So a lot of times that's not an advisable strategy. Taking two RMDs in 1 year could bump you into a higher tax bracket, and it could also have other ripple effects, like making you subject to Medicare high income surcharges if your adjusted gross income is too high. And there are some income thresholds that if your distributions push you above those levels, you may end up paying more tax on your Medicare premiums. All right. If my spouse dies and I get a big life insurance payout, do I have to pay taxes on that payout specifically? Yes or no? All right, most of you know this one. So the answer is no. You have enough to deal with during such a difficult time. So it's good to know that a life insurance proceeds or a payout paid because of the insured person's death are not taxable. Life insurance can often be a valuable tool also for passing tax-free money to your heirs at death. So it's a strategy that some folks will consider if they have excess income in retirement or funds that maybe they have to take as a required distribution and don't need for their living expenses. Sometimes life insurance can be a way to sort of leverage those dollars to tax-free income to their heirs. This question got some press in the last year as it was being discussed in the government, but how valuable must my estate be at death to be hit by federal estate taxes in 2021? All right, answers all over the board here. So I think it's safe to say that the current correct number is something that most of us will never get to. The correct answer is the 12.06 million. And It's 24.12 million or more for a married couple at the present time. If the value of an estate is less than that threshold amount, then no federal estate tax is due. As a result, federal estate taxes are not a factor for very many people anymore. However, that will change in the future as scheduled. The 2017 tax reform law more than doubled the federal estate tax exemption threshold, but only temporarily. So it's scheduled to drop back down to 5 million plus adjustments for inflation in 2026. So that would hit more people. It's something to talk about on an individual basis if you own a lot of property or a business or something like that, and your estate is exceeding that 5 million threshold, maybe something you want to discuss both with your financial planner and your estate planning attorney. If I'm over 65, can I take a higher standard deduction than other folks are allowed? Yes or no? We've probably got some folks on here who are above 65 and know that, yes, they can take a higher standard deduction than other people. For 2022, the standard deduction for most people is $12,950 if you're single and $25,900 for married couples filing a joint return. However, those that are 65 and older get an extra $1,750 in 2022 if they're filing as single or head of household. And if you're married filing jointly, if one spouse is 65 or older and the other isn't, the standard deduction increases by $1,400. If both spouses are 65 or older, the increase for 2022 is $2,800. So there is an additional standard deduction amount if you are above age 65. Small concession from the IRS. All right. Answer this statement. Everyone pays the same for Medicare Part B. If you were listening carefully, you may have heard the answer inadvertently given earlier. And apparently you were paying attention. So that answer is false. Medicare Part B is means tested. So in plain English, that means if your income is too high, you get to pay a higher premium for Medicare Part B. Follow-up question. At what income level do those Medicare surcharges apply? Got some different ranges there. All right, so the correct answer is approximately $182,000 if you're married filing jointly, or $91,000 if you're filing a single return. Those numbers are the modified adjusted gross income. So basically your income before you take your standard or your itemized deductions. If it exceeds that level, then you will have to pay a higher Medicare Part B premium going forward until your income drops below that level, if it does. Are Roth conversions a good idea for me? We're catching on with it depends. Yeah, so it absolutely depends. It depends on your tax and your family situation. It can be an excellent strategy for some, especially if you're currently in the lower tax brackets, like the 10 or the 12% federal brackets. It may make a lot of sense to explore Roth conversions as a strategy each year. This is highly individual per household. It really needs to be looked at based on your entire income situation, what you're expecting for the whole year from all sources, whether pension, 401k, working income, et cetera, and Social Security as well. So we talked about in several previous slides, if you would do a Roth conversion and thus increase your taxable income for that year, you may accidentally, if you're not careful, bump up your taxation of your Social Security benefits, or also accidentally bump up your Medicare premiums. So those are two things that we really have to pay attention to. But that said, in the right situation, the right setting, Roth conversions can be a great fit if your current tax bracket is low and you think your tax bracket or tax brackets in general may be higher in the future, which many of us do. Distributions from my traditional IRA are always taxable. True or false? All right, so we're going to give you credit if you said true on this one. It's generally true. There is one exception. If you are age 70 and a half or older and you have an IRA, you can make a distribution payable to any bona fide U.S. charity up to $100,000, and it's totally tax-free. So that is the one exception to a distribution from a traditional IRA being taxable. In all the cases that we know of, it would be counted as taxable income. So this amount that you might give directly from your IRA to a charity after age 70 and a half is in addition to the standard deduction that most people take. So we just spoke about how high that standard deduction has gotten in recent years and how most people don't itemize anymore because of that. This is a way that you can exclude some of what you would normally have to take from your IRA and pay taxes on by giving it instead directly to a charity. So I've found in practice a lot of folks that are above that age and charitably inclined already, giving to church, giving to Humane Society, Union County Foundation, other charities that they are interested in, can do those contributions directly from their IRA, support the charity, and also save themselves what would otherwise be some taxable income. Just like my IRA, I can also make a tax-free distribution from my 401k to charity. True or false? All right, a little bit of a tricky question again, and this one is false. You can only make a tax-free gift to charity from an IRA, not from a 401k, a deferred comp 457 plan, or a 403b, at least as of the present time. All right. So just to kind of wrap it up, the answers to the questions today were fairly general in nature. And of course, answers related to any tax questions are always based on a person's individual situation. So with any tax related questions, please consult a tax professional, a CPA or similar. These answers, like I said, are pretty general. If you have questions, you wonder how one of these things relates to your specific situation, whether it's a question for your financial planner or for your accountant, please feel free to reach out to us at info@mccarthyandcox.com. Or if you're a current client, you can email your advisor directly to follow up on any of these questions. We're not going to take live questions today because compliance frowns on us giving anything that could be construed as tax advice that they haven't pre-approved. But with that said, I'd like to thank you for joining us today. There's some things that we'd like to just share with you as far as McCarthy & Cox as a firm, just some very basic general things about the firm that people ask. So the first question is there a minimum for investments? Do I have to have a certain amount of money to invest with you? And the answer to that is it depends, like so many of our answers. So we do have some minimum requirements. We do have some spaces that we work in better than others, some folks that we are better set up to serve than others. And so if you're not a client and you call in, we'll have some conversations around kind of what your objectives are, what kind of help you're looking for, what you're seeking to do in your financial life, and we'll mutually arrive at a conclusion as to whether it's a good fit or not, whether it's worth you hiring us to help you with your situation. So second question is, are all of your advisors experienced? So we have 6 financial planners in the office. Anyone who is a partner is also a certified financial planner, and many of our junior advisors also working toward that certification. That in plain English just means that we're trained to look across the board at the whole financial situation and not just at investments or not just at insurance, but really how it all ties together. As far as experience goes, you can look on our website at our bios and see how long we've each been in business. I wish I could say I had been as long as Tom, but none of us can claim that at this point. Third question, how does McCarthy and Cox help me? So I can just give you, I think, an answer to that question, a few of the most common questions that we can help our clients answer. So the first question I get most commonly is, when can I retire and maintain my lifestyle? When is it feasible for me to make my exit from Honda or Nestle or Scott's or Cardinal or wherever? And it's really a process that we go through mutually to determine what are your requirements, what are your expenses, what are your income needs, and what sources of income are available to meet those needs. So we have a process that we work through with you to determine that and help to guide you so that when you make your transition, you really feel secure that you're not going to outlive your money. Second question we get is, most of our clients have a 401k, a 403b, a pension plan, some form of investment accounts that they've saved or accumulated over their working career. And the question is around how to convert those things from a savings vehicle into an income vehicle. And so there's many ways, as some of them we touched on today, many ways to access funds in those types of accounts, many ways to invest them, some more appropriate for a given situation than others. And so we work with our clients to help match up the investment structure with the income structure. The third major question is, what risks are out there? What things could come up that would torpedo everything that I have set out to do? And so that's not an insurance lead-in. It's just a process of, again, identifying what are those risk factors, what form do they take, and how can we protect against them? The fourth would be, just as we talked about today, how can I minimize taxes? I said at the beginning, two things certain in life, death and taxes. So it's a reality for all of us, but given the current tax code, given the framework that the IRS has laid out for us, how can we comply with that? How can we legally pay our fair share, but also take advantage of any provisions that are there that might be beneficial to us? Again, we are not accountants here. We are not CPAs, but we do review tax returns with many clients and often uncover opportunities or things to consider that may have effect in other areas of their financial life. The last question is, how soon do I need to get started? And so to that, I would say, generally, we would want to start a relationship working with someone on retirement if they're at least 50 or older and within about 5 years of retirement. That's generally kind of the time when we would want to start a process of planning with you. And again, it's very individual. So that's just a general answer. If you're younger than that, or if you're seeking advice in an earlier stage of your career, things like that, we've recently helped to set up a new company called Yellowfinch Financial that is designed to help folks in earlier stages of their careers to make good financial decisions early so that those decisions can compound and grow over time to tee someone up for retirement. So if you're interested, give us a call. We could talk to you more about either meeting with someone from McCarthy and Cox or meeting with someone from Yellowfinch, just depending on what's appropriate for your situation. Again, thank you for joining us today. Watch out for our emails on the ARC Investment Fund webinar coming up on April 20th. And if you have other questions, please email info@mccarthyandcox.com or email your advisor directly or call the office at the number listed on the slide. Thanks. Have a great day.